Hello everyone, and welcome to Financial Accounting. In this video, I'm going to be going over long-term assets. And long-term assets are divided into two topics, fixed assets and intangible assets. So we'll spend most of the chapter discussion going over fixed assets, and then the ending part of the chapter we're going to be going over intangible assets. So what are fixed assets? So these are long-term or relatively permanent assets, such as equipment, machinery, buildings, and also land. Land has a unique nature, and we'll talk about it in the coming slides. Other descriptive titles for fixed assets are plant assets or property, plant, and equipment. What I've seen nowadays is that many companies use the term property, plant, and equipment. I think it represents more the fixed assets more than anything else. Then fixed assets have some characteristics. What are these characteristics? One of these things is that they exist physically, and therefore they have tangible assets. So they have physical existence, as we can call it. So they're considered to be tangible assets. They're owned and used by the company in its normal operations, and they are not offered by sale as part of normal operations. Because if they're offered for sale as part of the normal operations, we refer to them as an inventory. So these are assets that are used in the operations of the business, but they're not used to be sold as part of the normal operations. So now let's classify the cost related to assets. So a cost that has been incurred may be classified as a fixed asset, an investment, or an expense. So we'll see how we can make this kind of decision. It's actually a two-step process. The first step is to ask or to answer this question: is the purchased item long-lived? So if it's a long-lived asset or long-lived asset, then in this case the item is recorded as an asset on the balance sheet, either as a fixed asset or as an investment. If the answer is no for that question, then we just record it as an expense. It's not an asset. So the expenditure would be considered to be an expense. Then the second question: is the asset used in normal operations? So if it's yes, then the asset is classified and recorded as a fixed asset. If the answer to this question is no, then we classify it as an investment. So I think this chart would summarize the whole process. So in step number one, we ask this question: is the purchased item long-lived? In other words, is the expenditure related to a long-lived item? If it's no, then we just expense it. If it's yes, then we have to head to the second question. Is the asset used in normal operations? If it's yes, then we record it as a fixed asset, or we can call it property, plant, and equipment. If it's no, then we record it as an investment. So items that are classified and recorded as fixed assets include land, buildings, or equipment. Such assets normally last more than a year and are used in normal operations. So these are pure plant assets or property, plant, and equipment, because these are things that are normally used in operations. Investments are long-lived assets that are not used in the normal operations, and they are held for future resale. So such assets are reported on the balance sheet in a section titled Investments. So let's say the company bought a warehouse, but this warehouse is not used in operations. They're just having this warehouse and they're planning to sell it in maybe a year or two. So that way it's an investment. It's not something that's part of its operation. So they record it under the title investments. So now let's talk about the cost of acquiring fixed assets. And here we have a few examples for buildings, machinery and equipment, land, and land improvements. So let us see some of the costs related to buildings. So things like architecture fees, engineering fees, or engineer's fees, insurance costs incurred during construction. And that's only during construction, because once the construction is completed and we have the building, any kind of insurance would be insurance expense. Interest on money borrowed to finance construction. Sales taxes. Any kind of repairs if we purchase an existing building. Repairs after the building is ready, these are repairs expense or maintenance expense. But repairs, if we bought the building and then we're making some kind of repairs to make it ready for use, then in this case it's part of the cost of the building. Reconditioning, so purchasing again an existing building. modification of use. Sometimes a company would buy a warehouse, and this warehouse was used for a specific purpose, and now they're modifying it to be a store. So in this case, that's a modification for use. Permits from government agencies to have the building. Again, that's part of the cost of the building. Similarly, let's see the machinery and equipment. What are the costs that can be included as part of the machinery and equipment? The sales tax. So, of course, the price of the machinery and equipment, the sales tax related to that, freight or the shipping cost, installation, repairs if we purchase that as a used equipment, reconditioning, again, if it's purchased as used equipment, insurance while it's in transit, assembly, putting it together, modifying for use, testing for use, and permits from government agencies. What's really interesting is testing for use. So the initial testing of machinery or equipment is considered to be part of the machinery cost. Then we have land, and that also includes the purchase price, the sales tax, permits from government agencies, brokers' commissions, title fees, surveying fees, delinquent real estate taxes, which are real estate taxes that were not paid by the previous owner, removing unwanted building less any salvage. So let's say we bought a land, and this land had an old building that's not even usable. So we demolished it and we sold the salvage, and we're able to get some kind of revenue from or money from the salvage. That would be deducted from removing this unwanted building. Grading and leveling also is part of the land or the cost of land. Then finally we have land improvements. And here we have things like trees and shrubs, fences, outdoor lighting, and paved parking areas or walkways. So all of these are good examples of land improvements. One thing I want to just give you a hint about is that all these assets are subject to something called depreciation, except for land. And what is depreciation? It's that these assets or long-term assets, they lose value over time due to wear and tear and due to usage. So, speaking of the cost of fixed assets, again, only costs necessary for preparing the fixed assets for use are included as a cost of the asset. Unnecessary costs that do not increase the asset's usefulness are recorded as an expense. Examples of these unnecessary costs, things like vandalism, mistakes in installation, uninsured theft, damage during unpacking and installing, fines for not obtaining proper permits from government agencies. Let's see an example. Assume Kimball Incorporated purchased equipment for $12,000. Freight costs of $600 were incurred to transport the equipment to the installation site. On site, installation cost $1,500 were incurred, which included $500 due to an error installation. So we had the $12,000, the equipment value, the shipping cost is $600, and then we had installation cost of $1,500, which included $500 due to an error in installation. Remember, if we have an error installation, that's not part of the cost. So the journal entry to record the equipment would be debiting equipment and crediting cash. But what should be included in the value of the equipment? It's the $12,000, the $600, which is the shipping cost, the $1,500, but we're going to exclude the $500, which were due to an error in installation. So you see here, it's actually, this should be $12,600, $1,500 minus $500. I think this is a typo. This should be $12,000, $600 plus the $1,500 minus the $500, and that would be $13,600. So the cost of the error in installing the equipment of $500 is not included in the cost of the equipment, but instead is recorded as an expense. Direct costs incurred in the construction of a fixed asset, such as labor and materials, should be capitalized as a debit to an account entitled Construction in Progress. This is just additional information for you to be aware of. Sometimes a company would construct a building, so they don't buy the building ready. So while they are having any kind of direct cost related to the construction of this building, things like labor and material used, in this case we debit a temporary account called Construction in Progress. When the construction is complete, the costs are reclassified by crediting the Construction in Progress and debiting the proper fixed asset accounts such as building. Again, this is not very critical right now, but it's just something for you to get a hint. And I think in managerial accounting, you can learn more about that. Now let's talk about leasing fixed assets. So a lease is a contract for the use of an asset for a period of time. The two parties to a lease contract are the lessor and the lessee. The lessor is the party who owns the asset. The lessee is the party to whom the rights to use the assets are granted by the lessor. So in other words, the lessor is the party who owns the asset and is leasing it out to the lessee, and the lessee is the one who's using the asset. And nowadays we see a lot of people leasing fixed assets. So I can lease a car from a car dealership instead of buying it. And why we do that? It's again because in this case I don't have to buy the asset. I'll just use it for a period of time, let's say 3 or 5 years. I'll give it back to the dealership, and I don't need to worry about like selling it after I use it for most of the most life of that asset. So leasing an asset has the following advantages. The lessee has access to an asset without having to spend funds or obtain financing to buy the asset. Also, expenses such as repairs and maintenance costs may be the responsibility of the lessor, and that's usually the case for some machinery. I don't know, for trucks it varies on the agreement. The risk of incurring additional costs because the asset becomes obsolete before the end of its useful life can be mitigated, and that's another benefit of having leases for fixed assets. So let me stop here. In the next video, we're going to be going over depreciation, and we'll talk about accounting for depreciation. We'll see the different depreciation methods used in fixed assets.